So welcome back traders, welcome to another Liquid FX YouTube video. Here we're going to be dissecting a Euro USD case study, so a trade taken on Wednesday the 14th of February, just a few days ago. And we're going to be dissecting how this trade was taken, why it was taken, and how you could have potentially got involved. And we're going to be going over some very basics of ICT concepts. So here on the charts here in front of you, we have the Euro dollar time frame. So what we need to understand straight away is three things. We need to understand our structure, we need to understand where we are in terms of premium and discounts, so our PD arrays, and we need to understand our fair value gap. So where are we tapping into, right? So let's just three things, right? Let's just put those three things there. So we need to understand our structure. If I just write that, we need to understand our structure. We need to understand our PD arrays, and we need to understand the fair value gaps, right? Where have we tapped into? Now, let's begin to dissect the charts and really look at these three concepts. So the first concept to understand is we have bearish structure, right? Because we see a low over here. We've taken out low to the left. So what we've seen over here is we've seen a break of structure to the downside. So we have a daily boss. And now from this, we need to understand that we have a new bearish structural dealing range to work with, right? From this high down to this low. So this is how we use the Fibonacci tool when it comes to PD arrays and understanding which PD arrays to look at. We have a premium high over here down to a discounted low over here. Now this here is our structural dealing range. So it's pretty self-explanatory at this point that we have a premium up here. So this is our premium. And down here is our discount below the 50% level, right? Discount, D for discount over here, right? Premium versus discount. Now, the next thing we want to look at, if we dive into the charts, right? We want to dive into the charts and we need to see we've reacted off a POI in the discount, right? This is a POI, right? So what makes a POI? Very simply, we've seen a shift in internal structures on the 4 hour. We see a massive fair value gap and we see it priced in the discount. So this is what makes it an area of interest or POI or a point of interest for long, the long way of saying POI. And it represents an area where we could be looking for potential buys. And that's exactly what we had over here, right? So potential buys in this region, right? So the region here in yellow represents an area where we're going to be looking for potential buys in the market. And this is exactly what we're going to break down on Wednesday using some of our basics of ICT. So this is a very simple higher time frame outlook of where we are. We're in daily discount, we've hit a POI, and we could be looking for potential buy trades. And that's exactly what took place on Wednesday. So let's go down to the 5 minute time frame and have a look at where we are in price. So here's where we are. Cool. So let's dissect price. So we understand we're in a daily POI. We understand we're in a daily POI. This here is a 4 hour POI marked up, right? This is a 4 hour POI, refined POI. So what's the first thing we need to understand? We understand that price has entered the 4 hour POI. So we see a 4 hour mitigation of this POI, right? So this is a 4 hour POI within the daily POI. So that's the first thing to understand. So from here, we could be looking for buys straight off the bat because we understand that price action will likely to give us higher prices from a demand zone, right? So now, what do we understand? What's the next thing we're going to be looking for? What is the next thing we're going to be looking for in price? Now, Wednesday, the 14th of February, we always start with our Asian range. Now, what does the Asian range achieve? The Asian range achieves a buildup of liquidity, right? So the Asian range builds up liquidity. It's the accumulation phase of the market. So when we talk about our AMD, this is what the A stands for, right? It's the A in the AMD. We see an accumulation in price. The Asian range builds liquidity, especially on Euro pairs, GBP pairs, and USD pairs, right? Especially USD denominated pairs, right? We see the Asian range accumulate the liquidity, right? And this liquidity is very important and we use it throughout our strategy, especially when it comes to the next stage of the AMD, which is the M, the manipulation. So how does that work? So let's dive into the chart and let's see what happened, right? This line over here represents the New York midnight opening price, right? So this is midnight Eastern Standard Time, right? So this is midnight Eastern Standard Time. It's very important you calibrate this to wherever you are around the world. This is New York midnight time, Eastern Standard Time, right? So what we see in the London or the pre-London session is we see price rally up. We see price rally up, right? So we see price giving us this high over here. Now, what is the purpose of this high? This is what we call at Liquid FX manipulation phase one or stage one, right? Manipulation phase one. And we need to ask ourselves, what is going on, right? What does the market achieve during this phase or this stage? Now, we have the Asian high over here, right? And this Asian high gets swept here. So what this represents, it represents a sweep of liquidity. What is the purpose of the market doing this? Now, the market will entice early buyers into the market, right? So the market entices early buyers through this price action piece, right? So here we see an enticement of early buyers, right? So early buyers, this is early buyers. Now we understand that in terms of our time, we're looking for a fair value gap in the London or the New York session. So we don't want to be buying off this first rally because this is outside of our time zones, right? London session is 7 to 10. We're looking for a ICT silver bullet from 8 to 9 in the London session, right? We haven't got our silver bullet, right? Our silver bullet is down here in the London session and here in the New York session, right? So we need to understand we should not be looking to go long because our timing doesn't align with price. Price action shows signs of higher prices, right? Price action shows that, but we are not aligned when it comes to our time, and this is very important when it comes to ICT concepts. It's time and then price, not the other way around. It's time and then price. So if we go down now to if we continue on following price action, we see price rip down, giving us, of course, we have our first stage of manipulation. Then we have what we call our second stage of manipulation, otherwise known as a turtle soup or just a manipulation or a Judas swing, right? But this is the Judas swing, right? This is also a manipulation. Now, what is the difference between this manipulation and the first manipulation we identified? Right. The Judas swing typically, or not typically, always represents the low of the day in a bull market, right? In a bullish day. So in a bullish day, the Judas swing will represent the low of the day, right? So what does this manipulation or this Judas swing achieve? So what we see is we saw early buyers enticed in this region. They get swept out by the Judas swing. Okay, so the Judas swing entices sellers, but also sweeps out those early buyers, sweeping liquidity in the process. Now what we see is if we follow basic structure, we see structural low, structural high, and we see a low down at the Judas swing. So what we've seen over here is we've seen price give a very clear shift in our M5. This is the M5, the 5-minute time frame. We see a very clear shift in structure. Boss, okay? Boss, break of structure. So how do we get involved, right? What are we going to do to get involved? Simple. We need to look for a fair value gap for our entry, right? Because a fair value gap is one of the 3 rules to an order block, right? So when we have an order block in the market, what we're looking for is we're looking for break of structure for price to return to a discounted, right? Discounted fair value gap for entry. So we understand on the daily time frame we were in the discount. So the 3 rules to an order block, right? The 3 rules to an order block. We're just going to write those down over here so people can see. We have our 3 rules to an order block, right? Now, what are they? The first rule is we must have correct PD arrays, right? So we understand that we're in a daily discount, right? We're tapping off a daily demand zone down here, right? So of course our first rule has been ticked because we're in a daily discount. So we should be looking for buys anyway. Our second rule is we must have a shift of market structure or a break of structure. And we have that here in this region over here. This gives us a clean break of structure, right? After the Judas swing. Now, the third rule is we must have a fair value gap in price. Now, a fair value gap or an inefficiency or an imbalance in price occurs when we have an inefficiency between the wicks of the candles, right? So as you can see over here, if I zoom into price action, we have a very clean fair value gap over here. This represents a silver bullet timing. So what we see over here is we see the wick of this candle. If I really zoom in so people can see it, we see the wick of this candle not touching the wick of this candle up here. So now that we see price come in and rebalance with this wick over here, right? So this is where our entry will be to be a bit more conservative. Not necessarily down here. We want our entry to be up here. And the reason for that is so we can get tagged in the trade. We don't want to be too greedy, right? We don't want to have those extra pips for no reason, right? Have a slightly conservative stop loss of 12.5 pips. And now from here, what do we aim to do? We aim to target M15 premium because we're buying from discount to premium, right? This is another very important concept. So from here, our trade gave us at least a 1 to 3, I believe a 1 to 4 even, just targeting the M15 discount over here. Sorry, M15 premium for a 1 to 3. A 1 to 3 RR trade was achieved as it was held into the next day using the power of 3, right? So accumulation manipulation, and distribution. So just to sum that up for people one more time so they understand, we have an accumulation in price, the Asian range. We see price sweep the high of the Asian range. We see price sweep the low of the Asian range before giving us a break of structure, validating our Judah swing, and we enter off the fair value gap in New York that allows that to happen. So once again, we have an accumulation in price here in orange. So the accumulation is the Asian range. This is the accumulation. We see a two-step manipulation, one in pre-London. So the pre-London entices early buyers. So this is manipulation phase one. Manipulation phase one. We see the Judah swing. Notice how the Judah swing is below the Asian range low. So this is the Judah swing, right? This is the Judah swing. And here we enter off an order block. Now, an order block here in gray will have three rules we've identified, right? So it needs to break structure. So the Judah swing, for it to be valid, it must break structure. And for our order block, it must be priced in the discount, which it is in this case, and it must leave a fair value gap. And we simply enter off the fair value gap, right? So we look for a long entry off the fair value gap, stop loss below the Judah swing, and we target at minimum our first manipulation, right? For a 1 to 2 or 1 to 3, right? And this is very simply how the trade on Wednesday was taken, right? How this trade over here was taken using this schematic, right? So that's essentially one of the ICT models that we trade here at Liquid FX. If you're interested, please sign up. We've got community, a growing ICT community for those who want to trade simplified ICT concepts. And if you like this video, give it a like, give it a thumbs up. And I look forward to seeing all of you in the next one.